Welcome to another real estate industry update. I'm Daniel Roccanti here with Kyle Paxton. In today's video, we're going to talk about economic and tax provisions of an operating agreement. All right, so this can get a little technical here, going into operating agreement, and we should probably state off the bat that we are not attorneys. Okay, so you always need to be talking to attorneys about operating agreements. There's a lot of legal stuff in there, but we are going to talk about most importantly the tax provisions as CPAs here. And that operating agreement is very important. It's basically the entire outline of how this business should be run, what should be done in certain situations. It's the if something happens, it's like, what did the operating say? Yeah, I mean, basically, anything from profits to people coming in and out of the partnership, everything. This is why a lot of people get overlooked this. But if you have a business partner, this is very important, should be very important up front, because this basically spells out how the business should be ran and in what such a scenario it is. So it's a very complicated matter here. We can't go over everything, but it's very important that most people end up by overlooking this, but they should not be. So let's kind of get into the first part, and that's kind of just like the financial contributions and distributions part of the operating agreement.
Yeah, so like Daniel said, we're focused on the economics and the tax here, right? So all the legal jargon can stay out of here. In a perfect world, in developing an operating agreement for your real estate LLC, you have an attorney and a CPA involved. And the attorney handles the legal stuff. The CPA handles the, adds input on the economic and tax provisions, right? It is just so much harder for CPA to come in after and then be the bearer of bad news on maybe if you've issued a private placement memorandum to your investors, or you've communicated how depreciation is going to flow to your investors, and that does not align with your operating agreement, which is the ultimate governing document, can create a world of trouble. We've had several instances of that over the last couple of years with clients we've onboarded where there's a disconnect between their understanding of what the operating agreement says, and maybe this is what's happened in other investments I've been in. So I think that's how it operates here. Attorney put in kind of standard language into the operating agreement, and you have a big disconnect there that creates headaches with investors, whittles away trust, and creates a headache for all parties involved. So talking about financial contributions and distributions, this is kind of basic stuff that needs to be included in the operating agreement, right? In a real estate partnership, we're talking cash. We want to put cash in and get more cash out is the idea, right? As a limited partner, if I'm investing into your real estate operation, that's really what I care about, right? And so the contributions and distributions are really the foundation of the partnership and how it's going to operate, right? So there's the initial contributions by the partners. This should be spelled out in the operating agreement by amount if possible. So it's very clear who's contributing what. If there is, if I'm contributing $1 million of cash, Daniel's contributing $1 million of property, it is very important that's spelled out in the operating agreement. There's tax provisions kind of attached to that can create some how it comes allocated, things like that. Daniel will speak to a little bit in this video. But all of that is very important to line out. You also want to add what instances would trigger or additional contributions would be needed. This could be, and you want to spell out whether those additional contributions are mandatory, voluntary, what the process looks like for capital calls. All of that good stuff is really important. And then the other standard language you really want to see in there is an overview of the capital accounts and how they're tracked, right? So, and what frequency they're adjusted. The capital accounts basically represent your contribution into the partnership. It's increased or decreased by your share of income or loss that's allocated to you, and also decreased by the distributions you receive out of the partnership. Your operating agreement should spell that out, what that tracking looks like, and what happens to that capital account if the entity were to dissolve. And so then talking on the distribution side, getting the money back out, couple things you want to consider is, are there going to be interim distributions made, periodic payments as the partnership off of the partnership's operating income? I'm getting rental income into my real estate partnership. How does that get paid out to the investors? Potentially there's preferred return arrangements where certain partners are entitled to a preferred return on their investment. That would be spelled out in the operating agreement. You want to make sure that's clear. And then Daniel's going to speak to the including language on distribution waterfalls and what that looks like. And then the last piece that you may want to consider for distributions is whether it makes sense for your partnership that you're making distributions out of the partnership on a regular, timely basis to cover your investor's share of their share of income or loss in the partnership. So it's important to keep in mind in any partnership setting, the share of income or loss allocated to you is not necessarily in line with the cash you received out, right? It's your share of the income or loss of the operations. And there's so many factors that go into play. We could talk about it in an 8-hour video and not even scratch the surface, right? But so all of those things need to be included on, the money going into the partnership and then how money gets out of the partnership. And each time you're making a cash distribution, you should be going back to your operating agreement and make sure it's in line with what's spelled out there.
Yeah, a big one I want to kind of emphasize on is capital calls.
Yeah.
Investors love distributions and absolutely hate contribution. They realize that I have to make a contribution when I'm first investing into the fund, but then nobody wants to put money back in. I just want money out. Unfortunately, real life happens, and that needs to really be spelled out. What happens when a capital call? If the fund needs money, okay, there's only two ways to get it. All right, your owners put money in the company, or you got to go get debt. Okay, so there needs to be some kind of wording in there that talks about these scenarios. Yes, before it all happens, we act like everything's going to go grand. We will never need extra cash, yada, yada. Real life happens. Cash comes up. Okay, there's a problem. We need a large amount of cash. All right, are we going around capital calling all our investors? Or are we going to try and get debt? Maybe we can't get debt because we already have debt on the place and we can't get any more. That's part of the problem, right? Real estate always goes up over time, but you have weird things happen like the '08 crash. You have a pandemic. You get areas where, just things happen. You need to make sure that's spelled out there and that all your investors know what the rules are when they're investing so that when this unfortunate event happens and you have to ask for capital calls from your investors, they are already aware that this was basically something that could potentially happen down the road. What I'm going to talk about next is probably the most important part of an operating agreement when it comes to tax.
Okay. Loaded concept.
This is basically the allocations of profit and losses. All right. So when you're getting your tax return prepared, it's like, okay, how are the profit and the losses allocated? All right. We talked about capital contribution. So normally you put money in the company and you get some kind of ownership. Okay. That ownership percentage, usually profit and losses in a very standard way, is you received it based on your ownership. So if I have 5% ownership in this company, I expect 5% allocation of the profit and losses. Okay. In a very simple world, that is how it works. And for a lot of returns, but when you start having these big returns and these investors and everything, it gets a lot more complicated than that. Okay. Especially because not everyone put money into the company equally. Investors are usually required, but what about the managers? Okay, there's a lot of times they don't put any money in the company. They're putting their time. They're basically getting ownership percentage based on their services. Okay, so cash isn't always equal for everyone else. So how does that work? All right, so are we just getting pro rata allocations based on our capital contributions? Yeah, maybe, but it's probably getting a little bit more complicated than that. There's probably going to need to be some special allocations, especially how profits and loss happens in a real estate fund. Basically, significant losses at the first year. That's usually what you're selling to your investors. Hey, we're going to do a cost egg. You're going to get a huge deduction the first year. All right. Then it's going to fall off. All right. At some point, it has to be profitable, or why is everyone else investing in this? Okay. So what happens when the profits start coming in? All right. There's basically a section 704, like B, basically. That basically is historically kind of the safe harbor of how most of these operating agreements and these allocations are. All right. This is kind of more of a cash follows tax. Okay. And basically it generally follows kind of the substantial economic effect. Okay. By basically, all right, who gets the taxes? Where's the profits and the loss kind of allocated is based on like who has actual economic effect here. Like if you've never put money in the company, should you really be taking losses? Okay. You know, if you put money in the company, like you should probably be getting more of the losses than some other people. So now it's not even being pro rata based on your ownership. Okay. So there's a lot of things that go on here, and making sure that proper capital counts are being maintained. Okay. And all of this is kind of comes down to what I consider the most part of the profit and loss allocation, and that is the waterfall provision.
All right, Daniel, go ahead and tell us about some waterfall provisions and how special allocations can impact that.
So all a waterfall provision is just basically how does cash flow and profits get distributed. Okay. When you got a complex and structure like a fund, it's not that easy. You have a lot of people you got to make happy. You got some people managing the fund, some people that are just passive investors. So how are you able to do this? This outlines everything. Okay, how is property, how is cash being distributed to the shareholder or the members, and basically this is pretty essential. Okay, this is transparency. So this is how all the investors, everyone that's a part of this, understands. All right, this is when I'm going to be getting my money, and this is going to be the taxes associated with it. Most people don't love phantom income. They like phantom losses, but if I got $10,000 in distributions, I'm expecting $10,000 in taxes. Okay, it doesn't always work like that, but that's what most people are basically looking for in this. This kind of spells out that, and then basically the taxes will kind of follow. Okay, and try to be as close as possible to this. All right, this whole waterfall thing right here is just by go ahead and getting it out. It's by aligning everyone's investment goals. Okay, what's the investor's investment goal? What are the GPs or the manager's investment goals? So that way everyone's getting some kind of return on this. And in the higher your risk is, more likely basically what your return is. Okay, so there's kind of traditionally or typically these are kind of the normal distribution steps or kind of tiers when it comes to a waterfall provision. The first is return of capital. Okay, everyone put money in this company. All investors want to get their capital back as soon as possible. All managers want to make their investors happy. So no one wants to lose money. That's all this really is. If I put $100,000 into this, I want $100,000 back. All right. Yes, I want to make profit. The worst thing you can possibly do is not return your capital. So this is usually the most important way. So in most waterfall provisions, the number one thing is everyone wants to get the return of their capital as soon as possible. Okay. There's many different ways to do this, but that's kind of just the general drift here is, all right, let's get our investors back their money, okay, as soon as possible. So that usually means the managers are taking nothing at first, okay, just the investors, all right? The next is a preferred return, all right? How do you incentivize investors? Okay, yes, I want my money back, but I'm here to make a profit. If I'm making no profit, I would find a different investment. All right. I'm selling my real estate fund because I'm selling that it's going to get a rate of return higher than other investments. Like instead of putting it in the stock market, say the stock market, you put in the S&P 500, on averages, we'll just say, somewhere like 7 to 10%, somewhere around there. Okay, that's great. Well, my real estate fund probably should be making better than 7 to 10%, basically. That's where your selling point is. Easy way to do this is preferred return. And so this is usually to your investors, not always. They can have multiple tiers here or multiple classes of this, but basically it's a predetermined rate of return. All right, this is paid out first. So say it's an 8% preferred return. That just basically means every year you're going to get 8% back. So even if the investment didn't make 8%, it's accumulating. All right, you're going to get paid out first before anyone else does. So everyone wants their cash back, and now they're getting their preferred return. Okay. Once everything is finally caught up, it's called the catch-up provision. All right. And this is usually basically saying, all right, we've paid all our capital back, we paid all our preferred returns. All right, we try to make the other people happy. This is usually the managers, okay? But basically, it's a catch-up provision. This is usually where it's a pretty special allocation, a large amount of cash is going to somebody. So basically, this is very common in funds that the manager gets no cash for several years. All right. Now everyone is fine that it's made profit, it's doing a great job. Everyone's been paid up to date. Preferred returns have been caught up. Now I need to get mine, basically. So this is a catch up. Basically, there should be some kind of provision in there so that because no one wants to do this for free. I mean, the whole point of the manager doing this, but it's a lot of work, is so that they can make some kind of money. Okay. Next one is carried interest. There's always a lot of talks about carried interest, and it can get very, very complicated. But really, all it is you're paying the managers a performance fee. Okay. We already talked about preferred, returns and things. So like say 8%, but what if it does better than 8%? Okay. Okay, well, we want to basically, investors want it to do better than 8%. We want this. Managers want it to be better too, so they want extra share of those profits. Okay, and that's basically what carried interest is. It's a share of those profits more than their ownership percentage if they meet certain kind of provisions in it. Okay, and it's just an incentive, all it is, to try to increase as much value and rate of return. So this is better for everyone. The member gets more money, and the investors get a higher rate of return. All right. So again, a normal one is just what is the average rate of return? If it does better than average, that's an extra little kind of kickback to the people running the fund. Okay. Very common in all of these. Last is just your common distributions. Everything else has been done. What happens to the cash? All right. Usually this is just paid out in proportion to your ownership percentage. Okay. And then upon liquidation, how's the last distributions basically sent out? How's all the cash and everything divided up? Those are kind of the main components to a waterfall provision.
That's all. Simple stuff, right? The one other thing I want to touch on in the special allocation space is depreciation, right? So a lot of times the real estate investments, you have the depreciation buzzword we talked about, kind of getting a cost segregation. You have a timing difference to where you accelerate deductions, and then ultimately there's going to be a waterfall at some point where you generally sell the property or refinance and able to get cash out of that. And so it's important to engage a CPA in formulation of these operating agreements, because there may be instances where it makes sense that you put in special provisions on how you allocate depreciation deductions based on who the owners are in the company. As an accountant, I am not a real estate professional, and so rental real estate is inherently a passive activity for me. There's major considerations on that and what I'm able to deduct. If I can pass my deduction to someone else who maybe is able to take more of a benefit to that, that's probably beneficial, in certain scenarios. So there's a lot you can play with there. And so I want to kind of circle back again to the fact that, sometimes we onboard new real estate partnerships and they have standard tax, kind of allocation language that you see a maybe less competent attorney or attorney who just doesn't understand tax provisions put in. There's no consultation with any sort of CPA. And so then you're leaving some cash on the table there for either yourself or your other investors, to where maybe there was a way you could optimize that better based on the facts of the entity structure, who's invested in, and all that good stuff.
Yeah, and kind of with the whole waterfall and everything, and we're talking about, it kind of goes back to that substantial economic effect, right? And what are you trying to get out of this? So it's like you were saying, maybe if I'm a real estate professional, maybe I really want to get as many losses as I can up front. Okay. But it's just a timing issue. There's going to be at some point a catch up. Okay. If I'm getting more losses allocated to me up front, I'm probably going to get more income allocated to me at some point to make up for it. So that's where this whole kind of like 704B and everything comes in. It's like, all right, what's the economics here? Your capital account matters. At the end of the day, you really shouldn't be having any capital left when the partnership ends. So there's going to be some kind of catch up. It's all a timing issue. Am I getting more income or more losses? This is where a lot of times we're talking about like cash will always follow what your actual profit and losses are. And it's just because basically I got more cash, but I was trying to accelerate my losses up front. Okay. But it's a great way to get investors, especially real estate professionals, because they love losses.
Yeah. I want to touch on briefly too, maybe some other kind of odds and ends provisions here. So, in the operating agreement, it should spell out who your partnership representative is, assuming we're talking about partnerships as our tax structure. So historically, this is a tax matters partner with the BBA passed in 2015. It switched to a partnership representative, and your partnership representative is the person who has authority to act on behalf of your partnership in IRS audits and other tax matters. That needs to be specifically stated in the operating agreement. There needs to be guidelines around communication or reporting on how that partnership representative is communicating with partners, findings of audits and other tax proceedings, and providing copies of notices, things like that. All of that should be outlined. And then the other big provision that is important to be in there is what happens in audit or amended kind of return scenarios. So I think there's a lot of misunderstanding in amending partnership tax returns in the last couple of years on what that process looks like. It is complicated. If you have to amend a real estate partnership return, especially one with a lot of investors, there's a lot of nuance to it. So outlining what that process looks like, who's paying the tax, if you're assessed additional tax on the amended return, is the partnership paying it? Does it get pushed out to the investors? How do the investors recognize that income on their individual tax returns if applicable? All of that has to be outlined in the operating agreement, so there's no misunderstanding in that scenario. The other issue is, and knock on all the wood around me, if you're in an IRS audit scenario, outlining what that looks like, the procedures to be followed. And again, we're bleeding a little bit into legal space here, but making very clear who the partnership representative is, what the responsibilities of this person is in kind of audit and amended scenarios is very important to include.
Yeah, I mean, we mentioned this before, but like the operating agreement, it spells out everything. It spells out how to handle every single scenario and situation. So you need to make sure that it is spelled out and it's what you actually want to do. So what happens in an audit? Okay, what's the operating agreement say? All right, who makes the decisions? All right, there's usually managers. You got hundreds of investors. You're not doing a vote. All right. It's usually not that kind of democracy. It's more of a republic. There's usually appointed people making the decisions here, okay? So your operating agreement spells everything out for you. And so a really important one that I want to talk about is basically transfer of interest, right? So in a partnership, you're going to have partners come in and out, okay? So it's important to have in the agreement, like what are the rules and procedures? How can members, buy or sell or transfer or change their ownership interests, okay? Most people don't want it to just be a free market, kind of like how stocks are. I can just buy and sell Google stock all I want, right? Well, partnership are more privately held. It's a lot more complicated than that, okay? So you usually don't want that. So it should spell out in the operating agreement, basically, this is to protect the rights of the members and the remaining members in there, okay? So people can't just come and go, all right? So first is usually some kind of restriction, all right? Right of first refusal, that's always in there. But basically, that just grants the existing members the right to purchase any interests of any membership willing to sell, okay? Basically, this keeps control within the ownership group, doesn't let you just sell to outside people. So if I want to sell mine, maybe the operating agreement requires me to sell it back to the company or existing members. That's a very common one. They don't want you just selling to any random person. Okay. Next is approval. You're usually going to have some kind of approval. Again, you can't just sell. This is not the stock market. All right. The other members are usually going to have some kind of vote a lot of times. Maybe not, but so you can't just turn around and sell it to just anyone. They have to basically approve it. There's going to be some kind of prohibited ones, all right? Like you might not be able to sell to certain people, types of entities. There's going to be a lot of restrictions going on. Everything's different. Every single operator, every single company is different here. But there's usually going to be something prohibited that you can do. Then it's going to talk about what is permitted. All right. So unfortunately, people pass away. When someone passes away, what happens in that scenario? Where does their interest go to? It goes to usually inheritors, family members. Can I just, even if I don't pass away, can I transfer my ownership to another family member or trust? I'm doing estate planning. My attorney told me to create a trust, yada, yada. Okay, what are the rules? Can I just transfer this to a trust? Maybe you can, maybe you can't. All right. There's usually going to be some kind of buy-sell agreement. All right. So if you're wanting to sell their interests, for any reason, death, divorce is another big one. Can't tell you how many times this happens. You have interest in something, you get divorced. Well, guess what? The court said this was 50-50, and now your spouse owns half of it, even though you 100% own it technically in name. How do we get the value out? We might be required to sell it or sell half of it. So, what happens in this? Okay. In this agreement right here, this spells out what you do. All right, now we are going to sell this. Well, what price do we sell it for? Is it a free market? It's really hard to determine what a privately held company is worth. Okay, so there's going to usually be some kind of valuation, agreement in here. Is there an appraisal? What are the buyout prices? What are the terms? What can I do? Can I do an installment sale? There's just going to be so many things right here that's happening. We already talked about this a little bit, but sometimes, events trigger mandatory transfers. We already talked about death. There's disability. We talked about divorce. Just anything that could be where it's involuntary transfers. Like, if someone passes away, it has to go to their estate at the very most. All right. So there's what happens in that. There can also even be different kinds of interests. All right. So maybe I'm selling an interest, but not a controlling interest. Okay. So basically just the interest to the rights of profit and losses and distributions. All right. But I'm not selling a controlling interest. How does that spell it out here? Okay. There's a lot that's going on here on the transfer of interest. The most important thing is just there needs to be something in here that covers every single scenario possible of basically partnership interest being transferred in these funds. And what's the rules? This is to protect the existing members. Okay. The last thing you want is basically someone coming in, and ruining the business. Like, hey, investors is probably not a big deal, but the big one is like managers. Like if something happens to a manager in a scenario, okay, who's going to come in and manage now? Okay, there has to be something spelled out there for you.
All good stuff. Again, loaded topics. We could talk about just the transfers of interest for 8 hours. We could talk about special allocations for 15 days. So we're barely scratching the surface there. The key is, again, kind of bringing us back. If you are forming an operating agreement for your real estate business, it is super important to have both an attorney and a CPA involved to make sure you have all your bases covered, and what you're ultimately documenting in the operating agreement is in line with what you think, actually how the business is going to operate, right? There's nothing worse than having that conversation on when I get a question from a client, I go back to the operating agreement every single time. And it is not a fun conversation to say, well, what you thought and what you told your investors is not what your operating agreement says. So we have a problem. How are we going to fix it, right? So,
and if you're dealing with experienced investors, they're going to want to look at your operating agreement before they even invest in you. So this should be something before you even set up the company, before you set up the fund. This should be done. Bring in an experienced attorney who knows how to deal with real estate funds, syndications. They are completely different than normal business. Do not just get a standard business attorney, okay? And then again, talking to your CPA about these tax provisions in there to make sure that it's exactly what you want to happen, and it's very transparent to your investors and you're making them happy. Thank you for tuning in to today's episode. We hope you found our discussion insightful and valuable. If you enjoyed this episode, please subscribe as we produce frequent videos related to real estate. Join us next time for more expert insight and tax strategies to help you maximize your real estate investments. Till then, stay informed, stay proactive, and happy investing.
We'll see you soon.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.